Hello and welcome back to the Note. It's tempting to say that we're back to square one. Of course, the year started with a very sharp sell-off at the beginning of January. 2 months on, we're almost back to where we started. Now, a large part of that sell-off was a scare over the possibility of a US recession. Today, we had a raft of numbers about the US economy. And if we take a look, first of all, at what they told us about US GDP growth, obviously nothing very exciting there, but no real sign of a recession either. These numbers have been revised upwards somewhat, plainly put the fear of recession back in its box to some extent. If you now take a look at what this means for inflation, this is the core inflation number from the GDP numbers. It excludes fuel, which would obviously keep inflation lower. It's the Fed's favoured measure of inflation, and as you can see, it suggests that inflationary pressures are picking up very sharply indeed. That, in turn, suggests that perhaps the justification for a rate rise might be picking up. And if we now take a look at the Fed funds futures market, the odds it's placing on rates being unchanged by the end of this year, you can see that we've now had 2 switchbacks in opinion this year already. We started with extra rate rises regarded as a total certainty. By only a couple of weeks ago, it was regarded as virtually certain there wouldn't be any rate rises. Now, at least one rate rise this year is seen as roughly a 50-50 shot. Uncertainty about rates is being reintroduced. Now, that is significant because the rest of the world really is relying on the US for its growth. If we take a look at this next chart, this starts back in the 4th of July weekend of 2014, which very ironically is when FTSE's index for all the world's stock markets other than the US peaked. Since then, as you can see, it's become mired in a serious bear market. Meanwhile, the US S&P 500 is, broadly speaking, roughly where it was 20 months ago. The rest of the world really needs the US to pull it through, and the kind of strength of the dollar that we've seen, thanks to the belief that rates are going to rise, has put a lot of pressure on those other countries. That is why this latest dose of good news on the US economy was treated almost as bad news. You saw the dollar strengthen, you saw stocks actually down very slightly here in the States. Now, there is perhaps one critical reason why we're not yet back to square one, why stocks are still lower than they were, and that is earnings. Earnings season is almost over now. We started the year worried about earnings. The actuality has turned to be much worse than expected. And if you take a look at this next chart, you'll see that, in fact, if you look at this under generally accepted accounting principles, the numbers that are normally bandied about are pro forma numbers, you can see that it's actually worse than it first appears. The gap numbers have been trending down for a while now. They are sharply lower than the pro forma numbers, and it's the gap numbers that in the long run the market follows. That, therefore, is where we are now. We're almost back to square one. We still have an overpriced US stock market. We still have worries about whether it can withstand higher rates from the Federal Reserve, but our worst fears about US earnings have been confirmed.